Welcome back. The House of Representatives says it plans to investigate the excessive charges on bank transactions imposed by deposit money banks in the country. The House also raises concerns that these charges are sometimes subject to double deductions. Take a listen.
The House is aware that most of the deposit banks in Nigeria impose excessive and non-statutory charges on varying bank transactions carried out by customers. The House is also aware that in January 2020, the bid to, among other things, stop the indiscriminate imposition of charges by deposit money banks, the Central Bank of Nigeria, CBN, issued a guide to charges by banks, other financial institutions, and non-bank financial institutions, stating the approved bank charges to be imposed by deposit money banks. The House is concerned that despite the guide issued by the CBN, some banks still deduct outrageous amounts of money from their customers in the guise of bank charges with different descriptions. The House is worried that in most cases, the deductions are already covered by the CBN-approved monthly account maintenance fee, AMF, those amounting to double deductions. The House resolves to mandate the Committee on Banking and Currency to investigate the excessive charges on bank transactions by deposit money banks in Nigeria and report back within 4 weeks for further legislative action.
All right, now to our next conversation. A report from CBN shows that banking assets grew in 2021 compared to 2020. Let's bring in Adeso Ojisholanke, our Director, Frontier Banks and Fintech at Renaissance Capital. Join us from London. Great to have you on the program. Good morning.
Morning.
Yeah, so quite impressive results we saw for the banks in 2021 that's looking at asset growth. It looks like it was a good year for the banks. What do you think drove this?
Okay, great. So last year, remember, first of all, we were 1 year post-COVID, and there were a lot of intervention measures by the central bank through COVID. So basically what you saw coming into 2021 was a lot of liquidity in the banking system. So if you also look at deposit growth, which is basically what funded that asset growth, so deposit growth was quite strong. A lot of corporates still not investing significantly domestically, so a lot of cash balances in the system. A lot of intervention funding also coming through from the central bank into targeted sectors. So all of that drove deposit growth in the banking system, ultimately funding asset growth. But unfortunately, when you look at margins for the banks, you saw a decline pretty much for most of the banks, and that's largely because majority of all that deposit growth coming through was mopped up by the central bank through the cash reserve. Okay, but that's basically what happened in terms of asset growth in banking system. I think outside of earnings, the trajectory it could have been worse. Let me put it that way. And I think what really helped the banks was around non-interest revenues. So remember, typically for the last 2 years, towards the end of the year, the central bank has been devaluing the currency towards the end of the year. So what that leads to for the banks is they report significant FX revaluation gains. And that's because of two things. They have these swap positions on their books. And secondly, they have sizable net long dollar positions on the balance sheet. So a slight change in the currency in terms of the currency getting weaker tends to lead to FX revaluation gains on the books of the banks.
Quite interesting. And we continue to see, asset quality trends in the industry improving. Despite the economy having had some shocks, through COVID. Why is this the case? And are the bank books really as good as they look?
That's a good question. The first way to try and assess the banking system is you need to also look at the macro dynamics. If you look at trade to GDP, Nigeria is probably similar to Kenya. It's probably about a third of GDP. But when you dive a little bit deeper into that, you find out that for Nigeria, about 85% of its exports are linked to oil. Okay, if you try and compare that to Kenya, for example, Kenya's trade basket is significantly more diverse. So there's tea, there's horticulture, and a bunch of other things. So what all of this means is that for Nigeria, the biggest implication to the economy when oil prices collapsed would have been, yes, the direct impact to the oil book in the banking system, but the second order effect is what all of that tends to lead to, which is a weaker exchange rate, tighter fiscal position, and what all of that means for the economy. But remember that during COVID, oil prices rebounded quite strongly. Secondly, Nigeria didn't lock down for as long as many other markets, even in Africa, or talk less of other developed markets. So basically, the economy didn't slow down as much as we saw in some other places. And I think that also helped the banking system. There were central bank intervention loans and a bunch of other forbearances that came through from the central bank that helped the banks and the asset quality from an asset quality standpoint. Nigerian banks also tend to have a relatively larger exposure to corporate loans, and corporates tend to be better able to navigate crises versus SMEs or retail customers. So this is like a combination of things that happened. And maybe the final thing to say is that coming into COVID, the banks had restructured a sizable portion of their oil and gas loans. They also had hedges in place, which also meant that when oil prices collapsed, the banks didn't suffer as much of a hit to the quality of the oil and gas loans during COVID. So it's a combination of dynamics going on there. But to the latter part of your question, is the quality of the books as good as it suggests? You need to look a little bit deeper, particularly when the way banks report there's stage 1, stage 2, and stage 3. Stage 3 is the NPL bucket. The stage 2 portion are loans that are a bit shaky and questionable, and that portion of the bank's loan book continues to grow. Okay, it's probably about 15 to 20% of the sector's loan book at the moment. And these are loans that are, they are forbearances, they are shaky, there's question marks here and there. They're not meeting their required obligations, but they're not bad just yet. And that portion of the loan book is growing. So it's important to pay attention to what's going on within the stage 2 loan book of the Nigerian banks.
Quite interesting, quite interesting. And margin pressure has been, a consistent, feature in the bank's recent results. What are some of the reasons, behind this, and where do we go from here?
The biggest driver is interest rates. All right, so interest rates have been declining for 2 years now. And from your last caller, you could also hear him talking about the highest rate you could get is probably about 13% on the long end of the curve. But for many of the banks that tended to manage their liquidity positions by investing in short-term instruments, interest rates, they are way below 10%. Okay, so this is leading to significant pressure. When you look at the total assets of the banks, about 40% of Nigerian banks' assets sit in cash reserves and special bills, something of that magnitude. And when you just think about that, these are assets that yield 0 to 0.5%. So there's a significant implication for margins for the banks. And when you look at last year, for example, many of the banks did see margin pressure. There were some exceptions. So banks like Access Bank, for example, and UBA. And this is because they tend to invest relatively more in longer dated bonds. So that helped them manage the margin dynamics much better. Now, looking ahead, the question is, where do we go? The liquidity situation is probably unsustainable, just given the country's macro dynamics, or should I say structure. Also, given where inflation is, it's also unlikely that you would see interest rates stay as low as they are for a long time. So I think the more rational thinking is that an adjustment is needed. There's also a fiscal deficit that needs to be funded. The government will need to borrow increasingly to fund that deficit. And to do that, the likelihood is that interest rates might need to pick up. So we need to wait and see how things play out. If interest rates do pick up, this is a significant positive for the bank's margins outlook. It's also possible that to drive lending growth, the banks might also need to have some sort of competition for deposits in that environment. So basically, the outlook from here, I think, is that margins are probably bottomed. And from here, the likelihood is that margins probably pick up going forward.
Right. All eyes on the rates right now. But, private sector credit extension, is captured in another series in the CBN's quarterly bulletin, which covers only lending by deposit money banks. It shows a total of about 21.8 trillion naira at the end of September 2021. That's representing about 17.8% year-on-year growth. What does this tell us?
There was credit growth last year. A lot of that growth went into a couple of sectors, and a bunch of that growth was also driven by the intervention funding from the central bank. So healthcare, manufacturing, a bit of oil and gas also drove that credit growth last year. And I think the final sector that also saw increased credit allocation was general commerce. Okay, the banks are telling us that they think there will still be credit growth this year. Our sense is that credit growth probably slows down a little bit, particularly just before elections. There are some things that could lead to a one-off situation. So there's some demand for credits coming through from oil and gas, particularly given the divestment conversations that are going on in certain places. We need to see how all of that plays out. Sometimes also credit growth is not always 100% organic in Nigeria. And what that simply means is that because over 50% of the banking sector's loan book is dollarized, this also means that whenever the exchange rate weakens, there is an FX implication on, so that 17% number you mentioned, a portion of that was FX driven also, just because of the weaker currency, or should I say the weaker exchange rate that happens in any given year also.
All right, so very briefly now, this issue, the reps probing banks over excessive illegal charges on customer deposits. What do you think about this, and what's your outlook for the bank's non-interest revenues?
I have to say that the banks charging excessively is probably not unconnected with the general macro challenges that the banks are facing. Remember that one of the traditionally biggest revenue drivers for banks is interest income. Okay, in an environment where your interest income has taken a massive beating and you need to figure out alternative ways to make money, naturally you look at non-interest. Okay, so a portion of that non-interest comes from fees and commissions, which is partly what you're referring to. And unfortunately, it's possible that some banks are charging significantly more than they should. But at the same time, when you look at other categories within non-interest income, this is why FX trading gains have become so sizable. They've grown. The FX trading, FX and revaluation type income is probably 30-40% of banks' non-interest revenues. And this has grown quite dramatically over the last 10 years. Fees and commissions have gone from about 2% of non-interest to over 20% now, right? So there's a lot of mixed shift that has happened over the last decade. But at the same time, I would also say that this probably also suggests why there is room for fintech companies to step in, right? Because some of these fees are not what customers like to pay. And I would also argue that in a more fairly competitive market, the fees are not what the banks should be for. Should I say transaction fees are not what the banks should be focusing on, but rather value-added services, right? This is the trend we've seen in many other markets. And increasingly, I suspect that this is how the Nigerian banks would evolve, particularly now that some of them are moving more to holding companies and trying to figure out other non-traditional ways of generating income outside of what the traditional bank does. So the scope of the banking industry is likely to change. So that's what I'm paying attention to going forward.
Okay, well, we'll see how the outcome, of this probe. Thank you so much for coming on the program. Adesoji Solanke, Director, Frontier Banks FinTech at Renaissance Capital. Thank you so much for coming.
Thank you.